Welcome back to the Investing Markets and Money podcast. And if you're watching this on video, you may be wondering why we're not in our usual studio, because we're coming to you from the Schroders studio in their offices in London. And this week we're talking about mid-caps, and we have Jean Roche joining us from Schroders, who is a specialist on mid-caps. She's managing the Schroders UK Mid-Cap Investment Trust. So we'll be discussing what is a mid-cap and some of the dynamics affecting UK mid-cap. So welcome to the podcast, Jean.
Thank you very much, and welcome to the Schroders head office.
Thank you. I just wanted to start off, for those who may not know much about mid-caps, I mean, how would you define a mid-cap stock?
Yeah, that's an excellent question. You can do it many ways, but in terms of how we invest for the trust, the universe we look at is a mid-250 index, really, and that is when you take the 250 stocks below the FTSE 100, the next biggest, 250 by market cap, and then you exclude investment trusts, of which there are many, you're left with about 168 companies. And so that is quite a fairly strict universe for us, actually. But some people would say a mid-cap is anywhere up to 20 billion. So you have to be very careful when you're buying your mid-cap fund, and look at what's actually in there and what people are defining as a mid-cap. So as a rough, I'd say, rule of thumb, 500 million to maybe 4 billion sterling market cap is where I'd be looking. And I'd probably be looking ex-AIM as well.
Mm-hmm. Yeah, it was last week I was at the Association of Investment Companies event, and that topic came up in the Q&A with one of the fund managers, questioning, is his mid-cap trust really in mid-caps or not? So there seem to be a lot of different definitions being bandied around in the investing community. But in terms of your trust, what's your investment philosophy when it comes to mid-caps?
I would describe my philosophy as a fairly open one, actually. And that's been very useful as the market changes its mood, as interest rates rise and fall. So we're open to two categories of stocks, what we call one category called the unique stocks and the other, which we call the flex stocks. And the unique ones tend to be doing something which has scarcity value. They might be disrupting. A classic example of that might be Trustpilot. There's nothing else in the UK quoted market that does what it does, which is providing a way, sort of like a loyalty currency for a business that might not be already known, or even for larger businesses now, which is starting to get quite interesting for them. And you get your Trustpilot rating from them and from them alone. And those kind of businesses tend to have high margins. They tend to be cash generative down the line when they're a bit older, especially when they've been around a bit longer. And they tend to trade at reflecting their scarcity value. They tend to trade at slightly higher multiples than, say, what we call then the flex stocks. And so for the unique stocks as well, what they do, the supply can't meet the demand for what they do, so they're able to raise their prices too. So they have what's called pricing power. So then with the flex stocks, that's another category we invest in, and that. There you've got, it might be quite a cyclical sector, for example, the house builders, or it might be a stock which is at a strategic crossroads. Maybe the management has changed after a long time. Maybe they're taking a different path. Maybe they're undergoing some sort of restructuring. And often they're buying back shares. They'll be at that stage of their life. And there you can expect those to be less expensive than the unique stocks because they don't have that scarcity value. Classic flex stock might be Hayes or Page Group, for example, because they're both sort of cyclical, and they're both I would say a classic, at a crossroads. But we have to find as well, they must be attractively priced unique or flex stocks that we're buying, and we assembled a portfolio out of a collection of attractively priced unique and flex stocks. But I think the really important bit is then what do we avoid? And what we avoid is stocks where management have been destroying value, and that's often by doing poor acquisitions or acquisitions at a very high price. Well, you can say that that's the same thing, or where there's not a clear strategic direction. So that it's not a very long list there, actually. But what we do is we categorize our investment universe into unique, flex, stocks to avoid, and then choose the most attractively priced unique and flex stocks.
And there's a lot of share buybacks going on at the moment. I mean, does that seem unusual to you, the amount of companies announcing share buybacks,
I think it's
even
really,
in the FTSE 250?
Yeah, I mean, that's a really fair point, and actually something that we've surfaced in our own data, just name-checking Duncan Lamont, our strategic, from our strategic research unit, who publishes a lot on LinkedIn and so on. And his recent work has really shown the percentage of companies doing significant buybacks, so that's defined as more than 1% of their own market cap in any 1 year. We have up nearly 50% actually of FTSE 100 companies. We have, if you include investment trusts in the FTSE 250, we have something like 35% of those companies. And then of the operating companies, 25% of mid 250 companies. So those true operating companies doing significant share buybacks. And actually in our portfolio, 15 to 20 of our 50 holdings are doing share buybacks. And that, even today, for example, Mighty is one of them, announced a new 100 million share buyback program. And I think what they're able to do, it's interesting. I think a lot of them paused dividends during COVID, became more cash rich. And I think what they're now doing is maybe a bit for growth, a bit for dividend, a bit for share buybacks. And many of them can do that holy trinity act of all three, which is quite, I think it's really quite striking. But then you have to think about, what's your view on share buybacks? Do you think they're a good idea, or do they concern you? Does their prevalence concern you?
I think just the prevalence is a little bit concerning at one level, but it's also, it makes me think they're just taking advantage of the current situation with the UK economy. A lot of fund managers saying UK stocks are oversold. It's a once in a generation buying opportunity. So maybe CEOs, CFOs thinking the same thing. Let's do the share buyback now before everything starts to pick up again.
Yes. Well, what my colleague Duncan was saying, in his data, he was showing that UK buybacks were more prevalent than in the US, even in the US now, and that you can really see the line rising in the UK. So I suppose the word of caution I would have then is does it mean that UK companies are staying further down the risk curve? And, the best ones will be doing maybe buybacks to satisfy their employee share options, for example, and offsetting it that way. And you can see Next actually doing a fair bit of that, because obviously we all know Next is the absolute emperor of buybacks in terms of how to do it, and setting the commandments of buybacks in stone. But I think it's something that's become very, very visible in the last, I'd say, 3 or 4 years. And so it's worth checking out the data, I think, and then questioning where it should go from here and what's the right amount, even when you do have I think that's right, a once in a generation buying opportunity, particularly for UK small and mid caps.
No, absolutely. And when we look at the whole UK stocks universe, what's the argument for mid caps versus large caps? Because everybody knows the large caps and the blue chips and love those. And a lot of people like small caps, but mid caps kind of fall in the middle there. What's the argument for investing with those?
I think, so if we take the large caps first, that is driven by a significant, a fairly short list of quite macro level themes. So whether you're looking at banks, whether you're looking at commodities, pharma, and they tend to be, more super tanker companies. So that's okay if you maybe have fairly strong macro views. And obviously, if you look at, say we stick with UK large caps, 75% of revenues ex-UK as well. So, taking probably a bit of a view on the currency there too. So very macro theme. And then if you look at small caps, you are going to have more accidents. You are going to have less well-known management teams. So one of the beautiful things about investing in UK mid-caps, and I've done it for a long time now, it was always my sort of, in the late 90s when I came to the city, it was always the area of most interest for me, is that you can have, management teams that you know from before. You can have, these are companies in middle age, but which can still change. They can still recreate themselves. They can go become a new, they can completely change their direction. They're small enough at the same time as not having the problems of small caps. They're small enough to do something new. And we calculated actually, so maybe you have 5 or 6 themes, I would say broadly in UK large caps, up to 85 themes niche growth themes in UK mid caps. So, quite small areas. It could be drones, it could be, I mentioned, Trustpilot earlier, it could be the currency of loyalty. You can get lots of smaller areas. I mentioned the staffers, it could be that side of things. But I think you can get small, high growth areas within UK mid caps in the way that you can't get in the large caps, but you get more stability, a more known quantity, and they also tend to have many of them very well managed balance sheets and more sort of predictable cash flow as well. So you get the growth with the stability at the same time, which I think is a very attractive characteristic. And then, of course, relative to large caps, you get the valuation. Particularly at the moment, you used to always, of course, you'll remember, mid caps always traded at a premium to large caps in the UK market, and that was reflecting their growth. But now you're getting the premium growth in terms of what's forecast, but you're not having to pay up for it. So I can't see what you wouldn't like about it.
And just thinking about the wider UK economy and the equity market,
Yeah.
I mean, as a manager focused on this area, I mean, what's your view on it?
Do we have to think about the wider UK economy? I think this is it, I think if you're buying an ETF, then maybe that's what you're thinking about. Yeah. But no, obviously, no, that's a facetious response. I think, of course, we have to look at the UK economy and think about whether there are areas which can sidestep that fairly soggy growth. But, I would say if there's a least ugly competition, the UK comes up fairly well in terms of economies, obviously more debt than before, but, in among the G7 sits all right in terms of growth. I think, so I would just say not the best, not the worst. We could talk about France and what's happening there politically, but, I don't think it's worth sort of pursuing that. I think what's more interesting is looking at the UK equity market, and I talked already about the fact that it's rich in value, and it is seeing a renewed energy and an overdue focus now on adjusting the rules and regulations in order to suit the users and suit the modern equity market. And I see that as a big positive. But I also think it is trying at the same time to stay distinguished and trusted as a market. So it's a really interesting market from that point of view. And I think it doesn't surprise me that we saw, again, my colleague, my strategy colleague, Duncan Lamont, surface this over the summer. This is why I think US investors just find the UK market so attractive to invest in right now, because they're thinking, what's the catch? But over the summer, you could see if they were leaving the US in terms of where they were going to invest, the first international market they're looking at, particularly over the summer, was the UK. And I think that's partly because, it's people know that here people do tend to play by the rules and play fair. Cricket is important. And I think, so from that point of view, the UK equity market is oversold, and it's really ourselves that are doing that. Because when you look at who's buying, we talked about share buybacks. My colleague Sue Nofka, head of UK equities here, she had a great slide she did for a presentation the other week, and it was, who's buying the UK stock market. So you have directors of UK companies, international buyers, you have private equity, so both trade and private equity buying UK stocks, and you have share buybacks as well, the companies themselves, as well as the management. And then you have on the right-hand side, and who's selling? You don't. Yeah. It's within. Yeah. And so that's a very short list of who's selling. And so I would say, that's. That I think that's possibly telling that maybe the UK funds are too critical of UK stocks potentially. That home-based investors are too critical of and too wary of UK companies.
I think that's a very good point. It's not one that's been made before on our podcast. And I was talking to some German fund managers last week, and they said exactly that, because I was complaining about the UK economy, UK stocks, and they say, I don't know what you're talking about. You're not seeing this from a sort of pan-European perspective. UK actually looks a lot better if you're looking in from the outside.
Okay.
And I think that's something a lot of British investors are exactly that. They're becoming a little bit too negative, and as a consequence, the market is looking incredibly cheap.
Yeah.
And FTSE, going back to the mid cap, any particular sectors or themes that jump out at you there?
Well, you mentioned Germany, and obviously the first thing that comes to mind is the defence sector. And the UK punches above its weight in the defence sector. Sorry if that's a terrible pun. But I think we always saw within this team, actually, and I work with Andy Brough, who you may know, who's been in the market for nearly 40 years now in UK small and mid caps. We always saw defence. Before it was fashionable, we had defence, as an inexpensive way to get exposure to technology. Because, as you will know probably as well, many of the best inventions come from defence initially. Many of the more creative minds work in that industry. And the UK has a very rich heritage there. So defence has been an area where we had exposure, and it was, it had been painful maybe 5 years ago. But the need for it, seeing it as a utility for its original, the clues in the name, it's defence, not necessarily attack. But it had been, I think, seen as a negative thing up till 3-4 years ago, until that all turned around for obvious reasons. The huge number of conflicts which have erupted in the last 3 or 4 years after a period of relative political stability, long period of peace, and I think people were lulled into a false sense of security, thinking the old wars are over, the old conflicts are resolved, and I think people were reminded of the reason why defence is a public good, why. If not to, I think I'll probably misquote, but if you want peace, prepare for war, my boy, or something like that. But I think that was sort of left behind, and now exciting stories like I talked about unique and flex stocks. I would say Babcock would be an example of a flex stock. That was one where capital was mismanaged, where poor M&A was done, and that would have been your classic flex stock where there was a strategic change of CEO and finance director. The two Davids coming in with the CEO there, and the FD coming in with the background in the industry, and fixing the balance sheet and the cash flow there, and refocusing. And that one is one which we bought when nobody was interested in defence. And then one thing that we do as part of our philosophy is we sell when stocks go into the FTSE 100. So that one has re-rated upwards, grown its top line, increased its margin, all those things you'd like. And this could be for another podcast, a multi-bagger to do, so which returns multiples of your original investment. And that one's gone into the FTSE 100, and we sell and we look for the next opportunity after that as part of our investment philosophy.
That's a bit tough, isn't it? If you've got like a gem in your portfolio and it succeeds, it does what you want it to do. It goes into the FTSE 100, and then you've got to sell it. I mean, that's really tough.
I mean, we could have said that about Royal Mail when it went into the FTSE 100 and fell out again, and then went in again and fell out again. We traded that both times. We generally find that this works quite well for us, but I think that's a fair challenge. And for example, we still have some Games Workshop in the portfolio. I think that would be, if you're looking for a unique stock, a definition, that would be one. But it will have, a ceiling for valuation, and it might be that you trade it a bit too. But generally speaking, there isn't, that's the only exception that we have made since I can remember, actually. And I joined Schroders 10 years ago, but maybe that's not very long for some people. But it tends to work quite well as a rule of thumb. Some companies go on, but many companies struggle and then fall out again. And then we're waiting to buy it again. As I mentioned, we did that with Royal Mail. So we didn't get a chance to have a hat trick with that one, unfortunately. We just managed to do that twice. But it can be a very interesting time when stocks fall out of the FTSE 100 to look at acquiring. So you asked about more generally, but themes. So defence, it wasn't just Babcock. Chemring and Kinetic were also strong performers, in particular Chemring. And the other theme that we have is much to, I think, sharp intake of breath. We talked about, not being that keen on the UK economy potentially, is UK retailers. I was a retail analyst for 10 years, so some people would call it an area of strength. Some people would say it was a weak spot potentially. But being very choosy about which retailers we do and don't own has been a theme as well. So the ones we don't own are maybe more instructive than the ones we do in some ways. So we have tended not to go so much for the consumer, maybe the C consumer, for example, the lower income consumer. But stocks like Dunelm, for example, sort of long-term stock market, turning into a bit of a stock market darling, and rightly so, with its returns on capital and its capital management, with the founder still involved there. I think that makes a big difference. So it's the number one homewares company for those who don't know it. But then also Currys as well, which came to I think a strategic crossroads really, and things were starting to change there with its balance sheet, with its pension. We could see the pieces starting to assemble in a good way there for them, with their Nordic business starting to be more on track, less stock that had been dumped there from the start of the Russian conflict up in the Nordics. That stock coming through, people starting to buy new laptops again after refreshing their home tech, which everybody bought. Everybody bought gadgets, didn't they? And then stood over it eating their lunch for the next 5 years, so they want a new one now. So that consumer electronics cycle kicking in for them as well. And then the beauty of investing in your home market, being able to go in and visit a couple of Currys stores, assessing whether my sons were welcome to play with the gaming kit in there, and how welcoming the stores were really. So, able to do a bit of research on all fronts. So yeah, choosing, being very choosy, being overweight retail, but being very choosy about where we're overweight has been a theme for us as well.
It's funny that with retail, the retail brands do have a culture, don't they?
Yeah.
And you can get a feel for it just, going into a store. You can feel if they're going off the boil, or you can feel like...
you're talking my language.
Yeah. Yeah, no, very true. Very true. Conscious of time, so
Sure.
I just wanted to ask you a little bit about risk management in the portfolio. How do you protect the downside risk as well?
Yes. Well, this is an investment trust, so and we do tend to gear it. So that will tell you about, I think at these evaluation levels is the right thing to do. But aside from that, it's closed-ended as well. So I think that really helps. You don't have to battle flows. You can time things as you wish. So that's one kind of worry taken away from the point of view of risk management, that sort of liquidity risk, shall we say, that you'd have with an open-ended fund. But generally, positions, we tend to keep them at below about 5%, I would say. We generally build up positions quite slowly, and I think in a very patient way. And I think that helps with the risk management. But we have our teams which will do, flag up various exposures, thematic exposures in the fund, sector exposures, so looking at if you're adding a stock in a sector, are you keeping you being aware of your sector exposure? So if you're buying that, you're adding to, say, I don't know, industrials, and do you sell a bit of another industrial to make up for it, or are you deliberately increasing your exposures? So we're investing from a bottom-up perspective, but then looking at what that does to the overall package. And then the other side of risk management is, I talked about the gearing the portfolio, and at the moment we're about 5-6% geared. We've been up higher, up in double-digit territory as well. But we look at the balance sheets of the companies themselves, and I think something like 75% of the companies that we invest in are geared at a net debt of EBITDA of 1.5 or less. And some of them will be net cash, probably 15 of them are net cash, 10, 15. So it's sort of keeping the look-through gearing low as well. So I think, that's kind of the sort of hands-on, practical way of looking at risk management.
That's so important with the debt, though. It's one of those, it can be really frustrating when you find a really good stock, but then you look at the balance sheet and go, No, those guys just carry too much debt.
Yes.
It's such a precautionary sort of orange light, as it were.
Yeah.
And a good reason potentially not to invest in a company. I'm looking back at the last 24 months. What would you say have been the key contributors that have been driving the performance of the trust?
It's very tempting to be quite short term, so I'm going to do that. I am going to do that. I'm going to give in to that initially. So I think what's very notable, I talked about the valuation opportunity. This summer we had 2 bids on stocks which were 7-8% of the portfolio between them. Unfortunately, not 10%. And the premia there, the bid premia, were between 75 and 100%.
Wow.
So
that's excellent. Yeah.
But those, again, in the case of one of them, the price in the end wasn't higher than the all-time high.
Yeah.
Yeah. So where UK stocks normally would have had bid premium in the past, would have been 30 to 45%, say. It was going up to 50% as a median bid premium over the last couple of years. But 75 to 100, I think those are, very, they are chunky premium, but that just shows you how far things have fallen.
Yeah. Yeah. Very good point.
So those one of those stocks was Spectris, the scientific instruments company, and the other one was Just Group, which is bulk purchase annuities, so insurance essentially, which is obviously a black box for many. But both of those bought by private equity, which is I talked to you earlier about the list of the buyers versus the sellers of UK stocks, so very much on the buyers list. And I think that, what are the lessons drawn is be patient, know your companies. And if you can see there's nothing, it's too cheap, there isn't an issue with it, and just wait and the value will be realised eventually. I think that's the lesson there. And, I think a lot of people are in a rush in this market. And that's, that's to the advantage of the rest of us who aren't.
Yeah. That's a very good point. Very good point. And then, it's tough looking ahead as well, but what do you see as the opportunities and the risks in the UK market? If we look ahead, say, for the next couple of years, which seems like a decent time horizon, from your perspective, what would you say the risks and opportunities were?
Risks. The risks are... if you are very exposed to sectors which are very dependent on regulation, government policy. So the financial sector is probably, you just need to be very aware of that and just don't pay up too much, be aware of that in how you value and where you get in at your in price.
Yeah.
Risks. Not enough new companies being floated. Yeah.
We've seen some new IPOs coming through, though, of a larger size, which, again, some brokers in the market are saying this is a signal of optimism.
Fill your boots.
Green shoots.
That is not investment advice. The brokers are, I did go to a broker, an IPO dinner, actually, in January, which seemed, seemed premature, but quiet. I'm seeing some of those come through now. In terms of, investor education and so on. I think if you think about a really big living room window, and then there's a top right-hand bit that opens, I think we're on like one notch open there. We had the beauty tech IPO, for example, which do the masks, which make your skin beautiful, for example, sort of consumer electronics like I described earlier. So that one was, that succeeded in going ahead in the last couple of weeks. So that IPO window is starting to open. I think it's all about realistic expectations by the sellers. But yeah, I think if you compare it to this time last year, there's a lot more life in the IPO market. That wouldn't be hard, I have to say. Yeah. But, the bids are coming in thick and fast. And we saw, for example, Big Yellow Group yesterday. So with news around potential bid there. And then all the other real estate stocks starting to move up in sympathy with it.
Yeah.
And then I think the opportunities, I mean, we talked about it's back to the valuation, isn't it? And then recognizing if the high growth that's possible by many of these companies. I mean, mid-caps are forecast to grow their earnings at teens levels over the next 3 years. And you've got the buybacks adding to that, of course, but there's actually real top-line growth from many of them too. And that, to me, is a fantastic opportunity. Great opportunity for good management teams to do bolt-ons and add value, because many of the multi-baggers we see do bolt-ons with internally generated cash. So, I think we're set fair to make strong returns in this market, which is ignored, reviled even, by the press. And I think your story about the German investors is a really good one, actually.
Yeah.
And we should bear that in mind whenever we're having a bit of a darker day.
Thank you very much indeed for coming on the podcast. It's been really good speaking to you. I could go on for hours, but I need to let you go. The day job calls. So thank you very much indeed, Jean, for coming on today.
The content of this podcast is for information and entertainment purposes only and does not constitute financial advice. The views and opinions expressed by guests or hosts are their own and do not necessarily reflect those of the armchair trader. Investments can go up and down in value, and you may not get back the amount you originally invested. Past performance is not a reliable indicator of future results. We do not provide any personal investment, tax, or legal advice. Always do your own research or seek independent professional advice before making any financial decisions. The Armchair Trader is a media company and is not authorised or regulated by the Financial Conduct Authority.